Shall we take a little step back on the trade data? Because there's been a lot of volatility underneath the hood over the last 12 months. So let me just say, we've seen this widening in the deficit. A couple of things to remember: that the deficit narrowed a lot in the first half of last year. There was a lot of uncertainty about trade. Then all of that was unwound in the second half of the year, and now we're seeing some normalization in trade data finally. So it's been a very volatile 2025. Now, the next thing is, how does this net trade deficit feed into GDP calculations and the Atlanta Fed GDP now that will be marked down as a result? We're seeing a widening in the trade deficit because imports are increasing a fair bit and exports declined, I think, a little bit in the last report. So the signal that we're getting from net trade is that domestic demand is actually resilient, and that's why we're importing more goods from abroad. Letting aside the effect of tariff policy on net trade, let's put that to the side for now, because that's not the argument we're trying to make here. The argument is the trade deficit is widening because demand is resilient and imports are increasing, and that's going to show up as a negative effect on GDP. But it might be offset by other components of GDP. If some of these imports are being used to build inventory levels, then I think inventories will make a more positive contribution to GDP and offset it to some extent. So overall, when I think about the net trade balance for the US economy, I'm going to look at the components before I decide it's a good or a bad data point for the outlook.
So, Blerina, tomorrow we're going to get some more inflation data, core PCE, which is certainly an important data point for the Federal Reserve here. What's your view? What do you think we'll see tomorrow? What's your view of inflation in this country?
So it's been difficult tracking and getting the inflation outlook right in the last few months, especially because since the government shutdown, we have those missing data points and the delays in the releases. But what we're seeing so far is a bit of a divergence between the CPI measures of inflation, which have been trending lower in recent months, and the PCE measures of inflation, which have actually outperformed CPI. This is very unusual for this statistics. And I think what's important, again, to keep in mind is that the Fed is actually targeting PCE inflation, not CPI.
Yeah.
So this firmness in PCE inflation, I think, reinforces my view that the Fed will probably do nothing until Chair Powell leaves the Fed, because they cut interest rate last year. Now they're seeing firmer PCE reports. We saw the employment data last week, which were actually not soft. And all of that reinforces this idea that we better stay on hold on interest rates for the first half of this year.
Blerina, this came up twice, even 3 times yesterday. Do you just assume various forms of stimulus, so to the election, whether it's President Trump or something else, who cares, that we're just going to have 5, 6, 7% nominal GDP? Is that possible?
The U.S. economy has shown remarkable resilience in the face of one of the sharpest interest rate increases since 2022. Then we had trade policy volatility. We had government policy volatility and shutdown. So nothing would surprise me if we get a resilient economy this year as well. But I also think we have the conditions to achieve that, because financial conditions eased a lot at the end of last year, and the Fed cut interest rates by 75 basis points. We also have a lot of capex in the pipeline. When you look at company guidance for AI investment, I think that's increasing in 26 relative to last year. And then we do have those tax cuts to the consumer that are coming in late Q1 and in Q2. I think all those factors, I think, should support the GDP growth numbers this year.